Welcome, everybody. Welcome to the Minds of Markets. This Minds of Markets podcast. This is an exploration in a deep dive into the minds of some of the best traders and investors that I know of in the market. And our goal is to help you, the listener, learn from some of the best out there. And really, we want to improve your knowledge and your skill set as a trader or an investor. The Minds of Markets podcast should be used for information and entertainment purposes only. And the opinions expressed in this podcast, there are opinions only. None of the information contained in the podcast constitutes a recommendation that any particular security, portfolio of securities, transaction, or investment strategy is suitable for any specific person. Absolutely, trading is risky, and past performance is not a guarantee of future results. All right. Well, today I am so stoked, actually, not because the Cubs just hired Craig Counsell as their manager yesterday, which hopefully that's an indication that they are absolutely going all in next year, but really because of my guest here today. And my guest here today is someone I've known for quite a long time. We actually went to the same college, but not at the same time. I'm a little bit older than him. That's the University of Illinois. And this is Mike Shorr, everybody. Mike is a former floor trader. He traded at the Board of Trade for a very long time, and he specialized in treasuries, grains, trading options, and both of those commodities. And this guy is one of those floor traders who had the ability to take what he did on the floor and the success that he had on the floor and transition that to trading on the screens like we're all doing right now. And let me just tell you something. I know from being in this business for almost 35 years as a floor trader and an educator, hundreds upon hundreds, personally, traders that traded on the floor. And it is a very, very small percent of those people, even the most successful ones, that were successful on the floor and able to transition that to on the screens. Mike is one of those guys. And you know what? His performance speaks for itself. This year alone, and Mike, correct me if I'm wrong when I get you in here, this year alone, I believe you're up 174% year to date. Last year, 2022, when we all know what happened in the marketplace, he was up 253%. Now, is that easy to believe? No. And Mike's going to tell you how he did it. But I see it on a daily basis. And this is someone that you need to follow. And you know what? The type of trade that Mike does now and what he took from trading on the floor to trading on the screens as, a desktop day trader now, quick trader, and his risk management is focused on day trades, quick stops, in and out, always focusing on the real liquid entities that are out there, things like the Qs or the SPY, or if he's trading options in a particular equity, something that has very, very liquid volume and a lot of open interest. So, you know what, Mike? Without further ado, I want to bring you in here. Like I said, I am so pleased to have you here. And I gave a quick background of what you traded on the floor and where at the Board of Trade. Yeah. I'd like you to kind of give a quick, brief outline of your history, specifically what you traded, and maybe give us a story or two from the floor that just sticks out to you before we start getting into the state of the markets and your thoughts about, what's going on, not just the next, 7 weeks left in the year here, but going into 2024 as well. So Mike Shorr, it's all yours, man. Thank you so much for being here.
All right. Yeah, I was thinking here, I think we're coming up on 11 years working together. So in January, wow. I think it'll be 11 years.
Well, am I allowed to say at least I kept my hair a little bit?
Did I have hair when we got here?
Yeah, maybe just a little.
I probably had more. Now I'm just shaving it. It's lost cause.
There you go.
But yeah. So, I got out of school and I really didn't know what I wanted to do.
University of Illinois, by the way, I said we went to the same college. That's where we were, Champaign-Urbana. Good basketball team this year.
I think we lived across the street from each other.
We did.
At the same time. But yeah, so I left school, didn't know what I was doing. I didn't know what I was doing. I didn't know what I wanted to do. And my uncle, who's not in trading, he was a computer software guy, but he introduced me to my second cousin who has the same last name. And but we had never met or anything like that. I didn't know who he was. And he said, you should meet him. So I went and met him, and we hung out for a while. He told me, why don't you go upstairs and hang out with my partner? I got to go back down to the floor. So not realizing it, being the dumb 22-year-old that I was, that I was being interviewed, I'm just sitting here hanging out and talking with this guy. I had no idea who it was. And at the end, they told me, hey, we'd like to offer you a job. And I was like, oh, okay. I was like, can I think about it? He's like, sure. If you want the job, be here at 5:30. And I was like, 5:30. I'm like, the market's closed at 5:30. And he's like, 5:30 in the morning. And I was like, oh, okay. So 5:30 in the morning. So that was a big reality check that, after, spending the last 5 years sleeping until noon.
And just so our viewers, know, and people that may not really be familiar with how people like us got into this business back in the day, right? There were no formal sending your resume and going through legal department and going through an HR department. If you knew someone, you got in to at least speak to the person who was hiring. And typically you were on the floor, as in your case, literally like the next day.
The next day.
Yep.
Yeah, there were two firms that actually came to Illinois, at least when I was there. CRT and O'Connor were the only ones that actually did on-campus interviews, and they were bigger concerns. These were, everybody thinks that it's all these big companies. Really, it's just a bunch of small companies, anywhere between 2 and 10 traders, and then those consolidated and got bigger, like your firm did. But yeah, so it was definitely a closed system. Education, I took some sort of finance options course in college, and I barely knew what a call and a put was at that point.
Yeah, we probably took the same one. I think it was like finance 300, 302 or something.
311.
Yeah,
in my mind, I don't know why it was. But really looking back on it, it had nothing to do with anything. It was about as ABCs as you get. So, but all of that was done in-house, and I always likened it to Kentucky racehorses. Everybody can trace their lineage back to about 5 traders, and we all learned this. We learned little bits of different things, but it all came through the same education program. And there was barely any books at that point, and certainly
no question about it.
Nothing like that we have out here. But so I started right into what I was told was the major leagues, which was at that point the 30-year bond pit, and learning on the fly as a clerk first, and then out of the graduating class of the clerks, 2 of us moved on to become traders, and then we became we were first junior traders, then senior traders, and then managers and things like that.
Speaking of 30-year bonds, wouldn't it be unbelievable to be trading back down on the floor right now over the last 9 months, year, with the volatility we've seen across the entire fixed income bond market? I mean,
everybody's like, well, rates aren't really that. What's the difference between 5% and 5.2%? It's not that big of a deal.
It is if you're standing in the pit.
If you're standing in the pit and you're trading in basically thousandths of a decimal point, then it's a big deal. Oh, yeah. And not only do we have a volatile market, I mean, the shape of the yield curve. That's what I keep on saying. I'm kind of glad that I'm not, because there are so many different games that are going on with the flow of money and all the treasury thing. You used to be able to gauge on where the bond is to where the 5 years and the 10 years basically.
Right, and that was called, if I'm not mistaken, and I never traded treasuries, but I had a lot of friends that traded. Was that called the fight?
The fight is the 5 over the 10.
Right, the 5-10.
Yeah.
Yep. All right, Mike. I want to know and I still don't know everything, even though we've been doing this together for 11 years, but our viewers want to know, okay, why are you so successful day trading? What makes you successful? And I don't want to hear, well, I've got 25 years experience, 30 years experience, which you do, because day trading is a very difficult thing to be consistent with.
Yep.
What makes you consistent? And in these markets, actually in any markets, that is the key, is consistency.
It's a lot less stressful, and I always say that, I don't want to have a P&L line that looks like we're up $5,000 one day, we're down $3,000, we're down $8,000, we made $10,000. That messes with your head, and that makes you question: Am I just kind of getting lucky here, and I'm still standing? Whereas if you consistently singles, doubles, maybe sometimes you hit a home run, but the home runs will come, right? If you are practicing and you are doing the fundamentals right, you'll get lucky and you'll hit one out of the park once in a while. But the thing is that you can't strike out 20 times other than that. So the biggest thing, and I've said that ever since I was teaching my own clerks, that the biggest indicator of whether a trader will be successful or not is their willingness and ability to realize a loss. And I know that sounds weird.
No, it is definitely the most, it's the most difficult thing for anybody to be able to be comfortable with is, man, I lost.
Right. I still get upset, on a losing trade, but it doesn't make me deviate. It's everybody, when they talk about trading, they think about, wow, we can make tons of money, I can get rich quick and be done with my job and all this other whatever that may happen. But most likely, if you're going into it with that mindset, it won't.
That's the 95% that I think people hear about and see in the headlines and read. If you Google, should I be a day trader or not? And, the results would be, 95% of people lose. That's because of that mindset.
It's absolutely because of that. And so you don't have to like it. Maybe you don't even have to accept it, but you do have to be able to do it. And it's hard to do when you're first starting, because people will say, oh man, I got stopped out again. Getting stopped out is not a bad thing. That means that you're managing your risk. If it's such a great trade and you get stopped out, get back in. What kills people are big losses. That's you don't people will complain about commissions. Nobody's ever blown out because of commissions. So get that out of your head and realize that commissions are really about the first penny that you make on a trade. So that's just making excuses for why you're not successful. And not
as cheap as what the commissions were when you and I were trading on the floor, when literally they were, you wouldn't even consider it. However, over the past several years, commission rates with retail brokers have come crashing down, which is great. And that's why, that's part of the reason why we've seen such an increase in trading and option volume out there. But anyway, go ahead again. I interrupted. My bad.
No, so that is the biggest thing, is having have a risk management protocol and follow it. I know but most people will say, yes, here's my stop, and then we'll be in a trade and we maybe got out for a small winner, a small loser, and somebody 45 minutes later will say, you know what do you think I should do with these calls? And I was like, and literally this is one of the things, I'm like, that trade has grandparents by now.
Yeah, you're 8 trades or 9 trades from there already.
Right. That is so out of my head that it's done, it's booked, get it out of your head, and none of that is going to take you out of the game. What will stop you is you staring at your loser for 4 hours, hoping that it's going to come back. Hope is not a business plan. Hoping that it's going to come back. You have nothing empirical to say why it's going to come back.
Yeah.
And if you did, why did you buy it when you did if you thought that it was going to go down there and then go back up? It's not coming back. And like I said, if you get stopped out, it's okay. So everybody worries about profits. Don't worry about profits. Worry about covering your loss, and the profits will come. It's a very simple thing, and it's very hard to do. Nobody likes losing money. I hate it. But
so with that also comes, there are gurus out there that you see will tout, 90% win rate, 85% win rate, right? And you and I know that that's a bunch of crap.
Yep.
That when you see that, what that means is someone is taking just an inordinate amount of risk and they're winning 9 times out of 10, but the one time they lose more than makes up for all of the gains that they had. So
yep.
I know that we don't trade that way. I know you don't trade that way.
No.
But you have told me in the past that win-loss ratio is not as important as some people may believe. And I know that people I talk to will say, "Oh, that's a bunch of crap. You got to have a win-loss ratio." What do you say about that?
It's certainly a metric that I do track, but it's not the first. It can't be done in a vacuum because, like you said, don't tell me about what you did when you won or how many times you won. What happened when you lost? I'm right 9 out of 10 times, and I blow you out on that 10th time. Well, that still blew you out, so it's garbage. So the way around that is to look at what is known as expected value. So it's your win-loss ratio, right? If I only, I don't want to win 1 out of 10 times. That's just swinging for the fences. But the expected value is how many times are you right and wrong? And then what is your return when you're right? And what is your return when you're wrong? And those two things together, so you just take your percentage of wins times how much money you make when you win, percentage or dollars, add that or subtract out the same thing when you lose. And if you have a negative expectation, which in our example of the 9 out of 10 times the guy's right, and then on the 10th time he blows you out, that's a negative expectation. So take for example 2022 to 2023. 2022.
Let me go back and reiterate, by the way, and correct me if I'm wrong. 2022, in a market that was just, we all felt it. We all felt like we were getting beaten up every single day.
Yep.
You were up 253%.
Right.
How?
And now, one, I mean, it took us a few months, but it was pretty clear that if you were going to be wrong, you were going to be wrong on a downside play. Just in general, it was just sell, and then buying was easy. If you had sold first, then buying is easy.
Yeah.
But and it was a looser market, meaning that the prices were moving faster. Look at the VIX, where it held for 6 weeks over 30.
Right, and with a 3 in front. Exactly.
You'll see VIX futures over 30, but to have it there for 6 weeks straight, that doesn't happen very often.
Yeah. And
you'll see spikes in VIX, but usually it's an overreaction. This was a constant put your feet in the fire and then put the rest of you in the fire. And it stayed that way. And now we have the VIX down in the teens again. So it's a different market. So you had my win-loss ratio last year was actually quite a bit lower than it was this year. Different market. So you had bigger runs both ways, but mostly to the downside. Bigger runs, but I was right, I was right less often than I was this year. This year, my win-loss ratio is a lot higher. So last year was like 55-35. We're seeing all year we've been at 65-35 this year. But I'm actually tracking for about 35-40% less return than last year. It's a different market. It's a really skitsy market. It's we get binary moves during the day, meaning that you go from point A to point B and then sit, where there's no real discernible trend except for the last move. And so it's like, okay, now we're going to go the other way. So I've had to tighten up risk because the market is, even though it's clearly going up today, but it goes up in such a slow, jittery fashion that it's hard to stay in these trades. And unless you're somebody who's going to take undue risk, which I do not, you're gonna make less. You're gonna be right more often, but you're gonna be right for less amount of money. So what do? You just you keep that you keep tightening your risk is what you keep doing. And so when you're right and you do get a runner, that's great, but you can't expect it. This is I'm running ridiculously low risk this year.
And what I have up on the screen right now is, you were alluding to is that period of time last year that you were talking about when we saw the VIX with a 3 handle in it, 34, an extended period of time. We typically don't see that. And, if you look at this chart here, you can see even this year, the couple of times that we've seen a pop in the VIX. So back earlier in the year in April, and then even in, just last month, we didn't approach 30, but even on those spikes up that got to the mid 20s and then 22, 23, it was so short lived. But going back to last year, this is that period of time you were talking about.
Right. And, so the former is more what it's like. You'll get a spike. And it's actually quite hard to make money as on a swing trade with a spike in VIX. I don't want to get into the elasticity of VIX options, but in order to be bullish on VIX and be right, it has to sustain that move, not just a spike.
Not just a quick popper. Yeah.
Right. Quick pop lets you know that, okay, people got caught wrong-footed and they're going anywhere where they can to get to cover this risk. And then that's over. That's more of a typical move. As I said, that, the VIX over 30 for an extended period of time, I don't remember it. Of course, for vast part of my floor trading, I knew what the VIX was, but it wasn't tied to the things that I was
exactly.
The VIX, for everybody that doesn't know, is tied to the implied volatility of the S&P in a broad sense.
Exactly, and to take that one step further, if you go by the rule of 16s, a VIX of 16 correlates to a daily move in the S&Ps of 1%. So if we saw that VIX in the 30 handle, so a VIX of 32 is a daily expected move of 2% in the S&P. Well, we did have a period of time where we were getting 2% moves on a daily basis. Doesn't happen very often, but we did see it.
So, if you look at an Apple, Apple's at $180. And
is that a little bit different from like the TLT positions that we'll take frequently that are TLT? For those of you that don't know what that is, that's an ETF based on a 20-year maturity that right now trades at $88.
Right. Yeah. And so that's $88. And, the thing with TLT is that it's an ETF that has a pretty loose definition of what they can do. And so it's kind of like when you and we've talked about UNG, where they have the ability to buy and sell domestic natural gas and then also exported and imported natural gas. They have that in their prospectus. So you might think that you're trading something, but they have a lot of leeway in it. And so you're like, well, why is TLT doing that? And that's just, it's kind of like a synthetic bond because, they know that nobody's just going to say, I'll take one treasury, please. Exactly. So that is the best approximation. It's certainly the most liquid right now. And if you're taking a broad, rates are going up, rates are going down, that's a good vehicle to trade it. But as far as, actually, you might be trading something that you think that you are and you actually aren't.
And it's not.
You're trading a huge basket of other things.
Got
and
it.
Then, 1996 rolls around. I had gone out on my own, and there was a flood. There was a flood in the upper part of the Mississippi, which is where a lot of the corn and wheat and beans come out of. And so I remember specifically, it was the middle of the summer. Nobody was doing anything, throwing stuff at each other in the pit. And
so what you did was you switched.
Pat Arbor, who was at the time the chairman of the board of trade, literally walks into the pit and in colorful floor language basically asked us what was wrong with us. And he goes, these guys can't get their orders filled over there. What are you doing here, jacking around? And so I was like, well, I was like, well, we need a full membership to trade over in the grains. I had an options membership, but because there weren't a lot of options traders, I could go over to the grain side and trade what normally would take a much more expensive membership. I could trade options. So I literally walked over there, stood outside the pit, and I put together some option curves. And I'm looking at this and I was like, these guys literally don't know what they're doing. and so I was like, I said to my partner, I said, you know what, we need to go in here. And so the next day, like literally we just nosed ourselves in there. And, at 1996, I was 25, 26 years old. And that was one of the, had I known now what I knew then, had I knew then what I knew now, it would have been a much different story because it was, a highly, they just didn't understand options. Options were something that, if you think it's going up, you buy a call. If you think it's going down, you buy a put.
Right. They didn't really understand volatility.
And they didn't understand volatility. And like going back to the treasuries where we're talking about, implied vol will move by a tenth, 7 basis points in a day. These, you're making trades, you're making markets that are vols wide, entire vols wide. So like,
I hear you.
10x. I'm sure you have some stories from
right about the same time that you moved over. Shortly thereafter is when there was a call on the floor of the SIBO, the options exchange, to go trade this brand new listed stock, this thing that nobody knew about called Amazon. And similar story, it was a July afternoon, and I am literally laying down in the pit doing a crossword puzzle. And there was a call over the loudspeaker, market makers over the Amazon pit. Didn't move. 10 minutes later, another one. I'm like, I'm going to go over there, see what's going on. And the rest is history. So pretty similar. And that's, that's for people that really don't understand capitalism or the way that the open outcry system worked. That was like the absolute nth degree. And it just doesn't happen anymore. I mean, there is still some open outcry. Fortunately, I get to be down on the floor of the SIBO a few days a week. And, it's still very vibrant, very active. S&P options trade there, the VIX, Russell. But it's certainly not like it once was. And, it's a shame. It really is a shame that a whole generation of people will only know how to trade in front of the computer screens and not standing up for 5, 6, 7 hours a day, literally elbow to elbow fighting with people for the next order. But I guess that's technology, that's change, and I certainly feel fortunate to have had the time being down on the floor that I did.
Yeah, and because if you're able to, and not like you said before, not a lot of traders were able to make that transition. I think it was probably easier for SIBO traders because you guys adopted computer trading on the floor way before. I mean, my last trade on the board of trade was in 2013.
Yeah,
and I was still carting up trades.
Yeah, we had some hybrid trading beginning like in the early 2000s.
Okay.
And you're right, because I remember for a brief period of time, I actually traded on the floor of the CME, which CME moved over to the Board of Trade building, but I traded S&P 500 options in the CME 2008, 9, that range right there. And yes, I was hand carding up trades. I mean, people wouldn't believe it. But anyway, I mean, we could talk about our war stories forever and ever and ever. But what I'd really like for you to get into, couple things. I'd love for you to explain to people, what your day trading is about, because you read the headlines, you can Google day trading, or you just hear all the pundits out there and they say, yeah, day traders, 95% of them lose and blow out.
Yep.
Okay, so that's number one. Number two, certainly, even though your trading and your expectations literally are minute by minute,
Yeah.
would love to get your take on the markets for the rest of this year. Are we going to get a Santa Claus rally like we typically do? What is the Fed going to do? How is that going to impact markets in 2024? What should we be watching for from a more macro level? So let's start there, and then we'll get into kind of your day trading regimen, if you will, day-to-day regimen.
All right. So state of the markets first.
Yeah, let's do that.
Right.
What are we gonna? We got Thanksgiving a couple weeks away.
Yeah.
Let me put something up here actually for our viewers to take a look at. So we've got this time of year coming up here that I'm hoping. Let's see if I can. I am, just so everybody knows, I am very, very not technology savvy, if that's what you call it. I'm trying to share a screen. I'll get to it at some point. Share screen. There we go. There we go. Okay. So I've got this chart up here. You want to talk to this?
Yeah. So, we see, the one thing that sticks out, well, there's two things that stick out. Two of them, or three things, two of them are behind us. The summer tends, the old adage, sell in May and go away, because, there's just typically, unless there's an outside force, be it geopolitical or something going on with, interest rates and things like that, the summer tends to be, even when there is stuff going on, traders still have to take time off, or they take it off whether they need it or not. And it's slower. And so there's apathy there. And a lot of people will just sell out of their positions. And so you'll see that on average, that your summer months tend to be your pullbacks, which usually turns into buying opportunities if you have the capital and the proper risk management to hold on to it. And then we get into where we are now, going into the holidays, and and where Nov and Dece, those are the 2 months that really stick out to the upside. Why is that? Well, people are coming back. I think a lot of it has to do with, remember, we have a lot of fund managers out there that need to mark their books, basically, get their positions, back up their positions by boosting them up, literally boosting them up.
You know what? You just actually gave me an idea for another topic on another podcast to talk about marking, but we'll do that a different time.
Okay. so they, because they, no matter what, they're going to report quarterly, but when people are looking at a fund or something like that, they are looking at, annual performance over 5 years, 10 years, last year, whatever it is. And they need to get it up there, and they want to get it up there, and you kind of wait till the end, right? Because if you're like, well, let's get it up there in August, and then we're good for the rest of the year. Well, that just gives everybody 4 months to sell it. And so if you mark it at the end of the year, you want to see a fight in the pit. Watch on December 31st, the settlement prices. Now, the market makers, we would try to mark our books against us, because what happens at the end of the year? Taxes. So if I can show a loss that's really not a loss, because I know where it is, if we can get the pit committee to say, you know what, this thing is it's actually worth $1, and we say, you know what, it's actually worth 85 cents. We just saved ourselves on realizing profits as far as the government's concerned. So, but the same thing goes with a portfolio manager that, at the end of the year, that is their finish line. Right. And so you'll see that run up. Now, you can't run you have a bunch of people trying to mark their books at the same time. You can't run it all up in one day. I mean, that's like, trying to turn the Titanic around on a dime. You can't do that. And so that's why, I'm sure there's books written on that, but really that's what it comes down to. Where are you at the end of the year? That's what people want to know. I don't care what you did from July until December. What did you do for me from January 1st to December 31st?
And is that part of the well-known Santa Claus rally? Is that why?
Yes, in the follow through from that, because now at Santa Claus rally, some people thinks it starts in early December. Some people thinks it comes after Christmas or Hanukkah. I guess that wouldn't be Santa Claus; it would be Hanukkah Harry or something.
Hanukkah Harry, yeah.
But they most likely have booked profits at that point, and they still have. It's not like January 1st, everybody just sells out of their positions. They're pretty much married to that, because otherwise you're putting yourself behind the eight ball from January on out. And now you're trying to get that back. So, I think that if I had to say, there's obviously no simple reason why that happens, but I think that that's a big reason, because a lot of people are paid on that return. Right, bonuses are based on that return. All of that, we have, these are human beings. These aren't, just bots doing this. December 31st is wherever our positions are. That's what our compensation is going to be based on for the year. So there's that too.
So I'm going to put you on the spot.
Yeah.
Okay, I'm gonna ask you to get out your crystal ball, or that that magic 8 ball we all used to have as kids when you'd ask a question and it would come up. I don't know. I'm gonna put you on the spot and say, okay, are we gonna get the Santa Claus rally this year, and are we gonna close higher than where we are right now? Today, S&P's today was the 7th winning day in a row. We closed at 43.78 and change.
Yeah.
So will we be higher from here on December 31st? And if so, how much?
I think so. Yes. No. There's a lot of things that can happen, right? I mean, this is. There's lots of things that happen in the world. That could.
Why, is there stuff going on anywhere?
I'm not a big fan of the news, but
yeah, exactly.
But things being as they are right now, this is about as kind of a overall marketplace that we've seen in probably 18 months, right? From the slide starting in January, February of 2022 to wherever we bottomed out, and now where we are. It's not like we are horribly extended. The fundamentals, earnings are, there's been some good, there's been some bad, but the things that are driving the market are generally good, even though that bar keeps going higher and higher. Inflation is not where it needs to be, but it's tracking the right way. And there's still a ton of money sitting on the sidelines. Look at Buffett. Buffett's sitting on record cash here. That means that he's not doing it because he likes sitting on it. I think that he's doing it because he sees some opportunities here.
So how much of what the Fed rhetoric over the last several weeks, especially last week's Fed announcement of holding rates steady again, and Powell maybe seemingly going from the dark hawkish side over to a more dovish stance. Yeah. How much is that playing into the rally we've seen? What could happen for the end of the year? And maybe more importantly, just what are we looking at going into next year? How much, I guess, is the bond market and interest rates dictating how the equity market is performing?
I think that has a lot to do with it, especially if for some reason, if bonds and everything else start rallying a lot, which means that then that's money being deployed, and people not wanting or not making the market pay them more.
Right. So in what Mike is saying, everybody, in many of you may know this, bonds and interest rates have an inverse correlation. So if the price of bonds rally, interest rates are coming down, and vice versa. So the big run up in rates that we've seen over the last 6 months, 9 months has all been because of a sell-off in bonds, because investors didn't want to buy because they were looking for more and more and more and more interest rate. on their money. Now we may have turned that corner, and that may be flipping a little bit. So sorry for interrupting. I can't.
No, I mean, if we see another wholesale sell market in the bonds, that's not going to be great for us. Just because that means that everybody's circling the wagon. Something has happened to where, I think the market is pretty comfortable right now. This is certainly about as dovish as we've heard our Fed be in a long time. If we had like if Google put out like a Powell Translate app, I think that like his last round of discussions, and we're going to see some more of that starting tomorrow. If you could just translate that whole thing is, and I think that I titled one of the Jolt articles, I think we're good, right? So like he's not going to say, hey, we're there, and we're just let it play out. And, where you can see like a bowling ball, you can see and you're like, oh yeah, that's going to be a strike and it's only halfway down.
Yeah.
That's about how relieved and cautious, he's not going to give the green light because he's seen what, his whole transitory.
Right. So I was going to say, we've had two, let's call it catchphrases from the Fed that have, everybody has encompassed. First was transitory. We heard inflation transitory forever and ever and ever. Then it became higher for longer, right? How much over the last several months have we heard higher for longer, higher for longer? The next one, as you just mentioned, might be we're almost there or something to that effect.
We're good, right?
Yeah, we're good.
And more importantly, you can sit there and listen to his pauses and everything like that. But just look at how the market took that. Look at how they're pricing in going forward. Going into DEES, they're pricing in basically a 90% chance that interest rates are going to stay right here.
And I know that the expectations are for a few cuts actually next year.
Yeah,
I still have a big problem with, and this is conversation for another time, a big problem with all of the debt everybody has racked up and delinquencies. But don't get me started. We can talk about that another time. We got to stay on topic here. I'm sorry.
No.
So, all right, I think I agree with you. I wouldn't doubt if maybe just because of this quick run up that we've had over the last week and a half since Powell spoke, maybe we get a little back from that. Maybe the market sells off a little bit, but I agree. I think we do rally into year end.
Yeah, I think that if we get any sort of meaningful pullback, I don't mean a downtick, but if we get pullbacks to 50-day moving averages or something like that, it's probably a buy, unless the reason why it's going down is that something has changed. Then
I agree. And for our viewers, let's see, we closed 43.78 today, SPX, 50-day moving average 43.47, so that's about 30 points below. 200 is down at 42.47. That was a significant support area up until we broke that 2-3 weeks ago before this rally. So those are some key areas to watch. Mike, this is unreal, and you and I could probably literally do this for hours upon hours upon hours. And
I thought we were just in the intro right now, and I looked up.
I think we'll have to do this over a couple vodka sodas pretty soon here, but really, really want to thank you. So two things I want to leave with. One, if you could tell listeners one thing about day trading, what would you tell them? And two, where can people find you?
One is it's risk management. Like I said, you don't have to be right all the time. So like with me, I don't even think about it. It's automatic. Now I don't use a template when I'm trading, but I do have my new traders. I have a template for them, like literally on the trading screen, where it forces them to put in, because a lot of people will say, yeah, I got a stop in. I got a mental stop. That means you have no stop in. Because what happens when you get to your mental stop? Well, you move your stop down, because I don't want to get stopped out. So risk management and consistent approaches and little bits at a time. Trading is not you can get rich quick. I used to say this all the time. Some Yahoo would come into the pit. I'm going to be like, you are in and out of this pit in 6 months, one way or the other. Usually it was carried out. Very few of them were on an island somewhere, as we're still sitting there slugging it out on the floor. You will be out of and so you don't do anything that will take you out of the game, because that messes with you financially, messes with you psychologically. And once you get that down, then it just becomes, it's not stressful. Everybody's like, oh, trading's stressful. Not when you know what you're doing. I mean, you're still human, but everything that I do is automatic.
Yeah.
Automatic stop.
I used to tell family, friends, everybody that asked me about it, and they'd say, man, how are you just, so even keel? I'm like, for me, going down to the floor every day, it was like going to a carnival. It was like going to summer camp.
The serenity of the pit. We talked about that.
We did.
I mean,
all right, where can people find you?
All right. Well, you can find us at prospertrading.com. You can see us on Facebook still, I think, Instagram. Scott's always tweeting. Scott, I look at Twitter. I don't tweet. If you want to follow some fun stuff, follow Scott on Twitter. On X.
Better yet, follow Prosper Trading Academy.
Follow Prosper Trading, and also follow Scott.
All right, Mike. Thank you so much. Honestly, we got to do this again, because you bring so much to the table here. You really do, and we
have a great team here. Let's be honest. It's not just me.
Yeah, I guess we do. I guess we do. I'll go along with that.
Nothing that we do is in a vacuum. Every time we think something's off, we ask each other. It's like, this looks messed up. Yeah, that does look messed up. We should do that.
No doubt about it. All right, everybody. Really appreciate you listening in. Minds of Markets. Okay, this is our podcast. We are going to be opening this up in a big way pretty soon here. We will be taking questions. You'll be able to contact us, but Minds of Markets, watch for us again very soon. Thanks so much, Mike.
All right. Thanks a lot, buddy.
Have a good one. Bye-bye. Bye.